Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to the latest episode of the Prime Property Finance Podcast with myself, Gareth Morgan. In this episode, we are going to talk about the 7 steps to protect your score over this Christmas season, holiday season, or sometimes described as silly season with the amount of shenanigans and chaos and carnage that comes with it. But don't let that damage all of your goals in 2026. Make sure you looked after your credit score. So let's dive straight in. "2026 has arrived. You've hit January with a credit card hangover. You've overspent, missed a payment, and now your credit score's taken a knock. Just as you're thinking about moving home, remortgaging, or investing in the new year. But imagine this. You enjoy the holidays and stay in financial control. Your score stays strong, your budget's balanced, and you start the new year in a powerful position to borrow, invest, or refinance. In this episode, we're breaking down how to protect your credit score and your future borrowing over the Christmas period. With these 7 simple steps to help you spend smarter, stay on track, and start 26 in a strong place. So what are we talking about? How to manage your credit usage, your spending habits, and your payment behavior over the holidays to protect your credit file and your borrowing potential. And why does this matter? Well, lenders check your credit profile before every mortgage application or finance application. One missed payment or maxed out credit card in December could cost you in the new year up to March. And so when is this relevant? From November all the way through to January, when people are spending more, using more credit and paying less attention because of the busy holiday period. And who does this apply to? Basically anyone that's thinking about buying, remortgaging, or applying for finance, or ultimately that just wants to keep a strong credit profile. So the 7 steps. Step 1. Know your credit score and what affects it. Your score is based on how you use credit and not just whether you have it. It's impacted by your payment history, your credit utilization, the credit mix, and recent activity. So that means how you've behaved in the past, how much of your actual available credit that you've got, and what type of credit that you're using. And whether, in terms of recent activity, have you behaved well recently compared to maybe in the past. So if you don't know your score, then that's a good place to start. There's plenty of places that you can look at it, simply at Clear Score or Credit Karma for free ones, or there's more expensive ones paid for, which are more in depth, such as Experience or Equifax. We'll put a link for one in the show notes to make it easier for you to get one. But definitely, if you don't know your score, then get it checked. Step 2 is keep credit card balances below 85%. So some people think that because they've got a limit of, say, £2,000, they can use up to £1,990. But that is effectively maxing out your credit card, and that harms your utilization rate. And that is one of the biggest factors in your credit score. So lenders will look at, well, if you've got £2,000 of available credit, how much of that available credit are you using? It's like an overdraft facility. If you've got an £1,000 overdraft and you're using £999, you are maxing out that overdraft facility. So a good parameter that we always guide is keep below 85%. So like I said, if your limit on a credit card is 2,000, then you'd want to keep the balance below 1,700. Ideally, somewhere under 1,500 to 1,000, with 50% utilization or less is ideal. So just because you can spend money on a credit card, it doesn't mean that you should. And that's especially true in December. Step 3, don't miss a payment over the holidays. Even one missed payment can stay on your credit file for 6 years and tank your score. Set up direct debits for minimums at the very least. If you can't set up a direct debit, then if you can, then really do it. If you don't, then set up calendar reminders in order to make manual payments, or just make it a rule that when you get paid, that you make a payment. And it's not just about how much you pay; it's about, more importantly, it's about never missing it. So even like I said, if we make a minimum payment at the least, you're not paying down in debt necessarily, but at least you're not missing that regular payment. Step 4 would be avoid taking out unnecessary credit. So every time you take out a new credit application, that makes a hard search on your credit score, and that can lower your score temporarily. We often hear people being told to take out a credit card if they've never had any credit, to take out a credit card because that will improve their credit scoring. Long term, yes. Short term, no. So actually, you will knock your score within the first 6 months, because one of the factors in a credit score is, have you taken out any credit within the last 6 months? And if you have, then it usually drops the score in the short term. And then as you use that credit and pay it off, use it and pay it off, use it and pay it off, after 6 months, then that will improve your score. But in the short term, then that can impact you. So if you're thinking about, maybe going to the sales in the Boxing Day sales, and there's a 0% deal on furniture or a store card, then think twice about it if you've got any mortgage plans within this next sort of 3, 6, 12 months. And just, ultimately borrow smart and not impulsively just because there's a good deal on it in the sales. Step 5 would be make a simple budget and stick to it. It's all well and good having a budget, but if you're not sticking to it, then it's pointless having it in the first place. So the best way to protect your credit is to avoid relying on it. Old adages, if you want something, save up and then buy it. And then actually, because the painful time has taken you to save up for it, you will then actually think twice about whether you actually need it or not when the time comes. It's much easier and more impulsive to buy something on credit or on finance without having saved up and spent the time and effort in saving for it. In terms of Christmas, this is the big one. Set a budget for Christmas gifts, for socializing, for travel, and use actual numbers and plan that out, and not just wishful thinking and we'll worry about it in the new year. Overspending in December can really affect your finances, not just in the short term, but through to next year and for the next couple of years if you really go over the top. Step 6 is don't cancel old credit accounts. So if you've had old credit accounts and that you've had for a long time, that shows that you've got a long-term credit history. Even if you don't use them, one of the measures that the score will take is older accounts, how old your oldest account is. So the older your accounts are, the better. And so, just keep old cards and just make sure that they're managed and secure and not at risk of fraud. And ultimately, your credit history, so the longer the history, the more credibility you have. So if you're going to cut up the card, you can do, but don't cut off the actual account. And then step 7 is start thinking like a borrower and not a spender. Lenders look at your credit profile as a reflection of your money mindset. So how well do you manage your credit? Because that shapes the deals, the rates, and the opportunities that you'll have going into 2026. Ultimately, a strong credit profile will give you more options than someone with a weaker profile, and ultimately that should be part of your long-term home and investment strategy. Always one of the best things you can do is manage your credit profile. So hopefully those tips have been useful. Ultimately, your credit score is more fragile than your Christmas budget. Protect it now, and your future self will thank you when you're locking in a better mortgage deal instead of fixing past mistakes. Thanks for listening to this episode. See you soon. If this episode has been a wake-up call, then good. We want you to enjoy the holidays and protect your future. If you're planning to buy, invest, or remortgage in the next 6 to 12 months, then please take these steps now. And if you want to help get a mortgage or be a mortgage ready in the new year, then click on the link in the show notes to look at your credit score if you don't have one, or you can drop us a message and get a call booked in to help you with that. Thanks for listening. As always, if you can review and share the podcast and subscribe, that makes a huge amount of difference to us and what we can do in the future. Thanks for listening. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested, and of course subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.